All right, hi everybody. And today we're going to talk about three ETFs for monthly dividends. And these are ETFs that I've researched, and I believe they can make a good part of your portfolio. So before we get started, though, I just want to mention one thing real quick. And that is thank you so much, guys, for the support you guys have been giving this channel. We're almost at 200 subscribers. You guys have been liking my content, you guys have been subscribing, and I really appreciate it. I just want to say thank you so much for the support. This channel is growing faster than I thought. I mean, we're only at 200 subscribers, but if you're new to this channel, you can help by hitting that thumbs up button and hitting that subscribe button. 200 subscribers may not seem like a lot, maybe if you see these bigger YouTubers, but I think it's a pretty good amount for me right now. I'm pretty happy with it, but I want to grow the channel even more. So if you guys would hit that subscribe button, hit that thumbs up button, I really appreciate it. And let's get started. So the first ETF I want to talk about is the Invesco High Dividend Low Volatility ETF, or SPHD. And this ETF has a solid share price performance, moving from 25 bucks in 2013 up to a high of about $45 per share. Now, the recent volatility, of course, has caused this ETF to drop in price, but it's not just about the share price with this ETF, because you also get a solid dividend yield of over 5%. So here's the dividend yield. That's the distribution rate, or in other words, the dividend yield, 5.60%. Now, the 12-month distribution rate, that is going back the last 12 months and taking the average dividend yield. So it's 5.55%. That's a great dividend yield, and that just kind of shows you that the dividend yield does fluctuate, but it remains fairly consistent. And what I've seen this ETF in is between the 3 and 5% range. So that's where I've seen this exchange-traded fund, the dividend yield for this ETF. But as you'll see on the right side here, the management fee is 0.30%, which is 30 basis points. So if you invested $10,000 into this ETF, you would pay about $30 on an annualized basis. And that is not, it's not the cheapest in the world, but it's not the most expensive in the world. There are ETFs that pay or that charge lower expense ratios, and there's some that pay higher or charge higher expense ratios. But all in all, this ETF has reasonable expenses, and 30 basis points really is not a lot, especially when you consider that you're getting a 5% dividend yield. Now, this is just going over the sector or the sectors that this ETF is invested in. And the top 5 sectors are real estate, utilities, consumer staples, financials, and energy, and on down the list. So what this ETF tries to do is it tries to minimize the volatility that you're going to get from the stock market crashing. So it has 51 holdings, and those 51 holdings are, a lot of it, like I said, is concentrated within utilities and consumer staples. And it's one of those things where this ETF can be good because it does lower volatility based upon the sectors that it invests in, more defensive sectors. You'll see energies on there as well. So it's a good ETF. I really do like this ETF. Now, one thing I will say is that the dividends, so there's 2 types of dividends. There's qualified dividends and there's unqualified dividends. Now, this ETF, I believe, is primarily qualified dividends, which are taxed at a lower rate than unqualified dividends. The cap for qualified dividends is 20%, and that's if you're in the top income bracket. But for most people, they'll pay either 0% if they're on the bottom threshold of income, or 15% if they are kind of in the middle. So this is, I believe, mostly qualified dividends. Now, with real estate, and they do invest in real estate investment trust, they don't get that tax break from, so the real estate investment trust do not get a tax break. But dividend paying stocks in the US, which this ETF invests 100% of its portfolio in the United States, typically those companies will get a qualified dividend tax break. So most of your income from this ETF will be qualified, but I think the one sector where it won't be qualified is real estate, because those real estate investment trusts are not exempt. And unfortunately, it does make up the largest portion of the portfolio, but it's one of those things where even though it's 18% of the portfolio, I'm almost certain that the rest of it is qualified. But leave your comments below. Let me know what you think. I'd love to hear what you guys have to say. So here's the market cap and style allocations. So it invests primarily in large cap stocks, which definitely helps to lower the volatility. I mean, when you're investing in high quality companies that have been around for a long time, it's definitely going to help to lower the volatility. Now, it does invest in some mid cap stocks as well, but the small cap blend is only 1.93%. So, I mean, it's one of those things where it's primarily large and mid cap, mostly large cap. But as you'll see here, it invests 36% in mid cap value stocks and then 6.76% in mid cap blend stocks. And then the small cap, it's practically nothing. So, and that's the thing. At least they're investing in small cap value stocks, which are different than growth stocks. And that's another video. But it's one of those things where this ETF definitely is good, not only because it's diversified, not only because it has many different holdings. In fact, I think I mentioned it had 51 holdings, but all the holdings are within the S&P 500. So it's one of those things where like this ETF is going to be a good growth investment as well. But on top of that, you're getting a very good dividend yield. So SPHD, I would definitely recommend at least considering it for your portfolio. And one more thing with SPHD, just showing you the dividend growth. I think there's actually one more slide after this, but here's the dividend growth per share. In 2012, it was paying about $1 per share on an annualized basis, and now we're up to about $1.75. So that's about a 75% dividend growth in the past 8 years, which isn't terrible. That's actually pretty good. So it's just showing you the dividends have been steadily increasing over the last several years. Now, here are the actual dividend amounts. So the dividend in 2019 and all throughout 2020 so far has been about 15 cents per share. But like I said, that dividend is steadily increasing. And as you'll see here, it does pay dividends on a monthly basis. So every single month, you're going to get that 15-cent dividend for every share you own in this ETF. And I would expect the dividends to keep on growing in the years to come, considering that S&P 500 companies typically have a history of increasing their dividends. So the next ETF I want to talk about is the Invesco High Dividend Achievers Etf, or PEY. Now, this ETF has had a very good share price performance since 2009. It was at about $6 per share, and it went up to about almost $20 per share. But of course, it's come back down due to the recent volatility. But it's had I would say, maybe you don't think that's amazing. Maybe you don't think that's an amazing share price return, but I think it's pretty good, because you also have to factor in the dividends as well. And that's always something to consider, because when you reinvest those dividends, you're going to have compounded growth. And the dividend yield for this ETF is very high as well. So the dividend yield is 5.14%. As I mentioned with SPHD, the 12-month distribution rate going back the last 12 months, taking the average dividend yield, is 5.29%. Now, the one thing with this ETF is that the expense ratio is a bit higher. It's 0.53%. So you figure $53 on a $10,000 investment. Now, the thing about this ETF, PEY, it's investing only in companies that have paid dividends for at least 10 years in a row. So they've raised their dividends for at least 10 years in a row. So, and this is every year for at least 10 years. So you are getting companies that probably will continue to increase those dividends in the coming years. And that's what you want to look for, because consistency is key. Like, there's something called the S&P 500 Dividend Aristocrats Index, where the companies within that index have increased their dividends for at least 25 years. And then you have the Dividend Kings Index, which is for companies that have increased their dividends for 50 years or more. So 10 years, right? Not as good as 25, but this also gives you more growth potential, because these companies within this index most likely are going to keep on increasing those dividends. Now, not all of them will, but a lot of them will. And so the companies within this index, if they keep on increasing that dividend for the next 10 years, you might have higher growth than a company that's been around for, let's say, 25 or 50 years and is a large cap company. So you might have more growth within this ETF in terms of dividends, but also in terms of the share price, because companies that increase their dividends are typically rewarded with higher share prices as well. So it's definitely an interesting ETF, and it's one of my favorite monthly dividend paying ETFs to buy for your portfolio. So once again, this is just going over the sectors that this exchange traded fund invests in. It has a lot of exposure to financials, but it also has exposure to more defensive sectors like consumer staples, utilities, energy, and all of those sectors. So I always look at the sectors because that does affect your performance, or it can affect your performance, because let's be honest, some sectors perform better than others, especially in a recession. But it does have a lot of defensive sectors in this ETF. And remember when I was talking about the last ETF, SPHD, and whether or not the dividends were qualified or unqualified? Well, I know that PEY also has 100% US exposure. So I do believe that all of the dividends from this ETF are qualified because there's no real estate in this portfolio. So it's all dividend paying stocks, no real estate investment trust. And for that reason, I'm almost certain, and correct me if I'm wrong, I'd love to hear your thoughts in the comments, but I'm pretty sure they are qualified dividends. So like if you're an average income earner like me, you'd pay probably 15% on your dividends, versus if you're a high net worth individual, you pay 20%, which is a lot lower than 37%. So you pay a much lower tax rate. And that's another reason why I like this ETF, because you're not paying ordinary income. You're paying basically the long-term capital gains rate. Like if you're me, for example, I believe no matter what, if I sell a stock and make a profit on it, I'm paying 15%. So it's the same as basically paying a long-term capital gains. And if you're living off your dividend income, this is going to save you a lot of money, because let's say you're making 50 grand a year off dividends and you only have to pay 15% of that. So you're getting to keep most of your money, which is awesome. And this is just going over the different large cap and mid cap, as we talked about with SPHD. So large cap makes up 32%, mid cap makes up about, I would say that's about 35%. Now this does have more small cap exposure, but here's the thing. Remember what I just said about how this ETF only invests in companies that have increased their dividends for 10 years. So a lot of these small cap companies might become very valuable in the future. Now, there's no telling exactly what will happen, but I think that it's very diversified. So you have some small caps for growth, and you also have more large cap companies as well. But this ETF in particular invests in 52 holdings. So SPHD invests in 51, and this ETF invests in 52. And there are some of the same companies in both ETFs. So maybe just choose one of them, because there's something called overlap where it really provides no marginal benefit to buy both ETFs. And that's another discussion. But I like this ETF better than SPHD, actually. And I actually just learned about this ETF quite recently. So it's one of those things where I would definitely consider PEY. I'm not saying SPHD is a bad investment, but I like this ETF for more of the growth potential because it's investing in small cap stocks. But in addition, there's no real estate investment trust, so you don't have to worry about the dividends being non-qualified, qualified dividends. And correct me if I'm wrong on that once again, but I'm almost certain that is the case with this ETF. So this is just showing the dividend growth over the last several years. This ETF has been around since 2004. So it ran into some trouble during the financial crisis, going from, I guess that was about 70 or 65 cents per share dividend, all the way down to about 35 cents per share. But now we're almost back up to 75 cents per share, which is about 100% dividend growth. So that's pretty good. And that's what you want to look for, is just an upward sloping trend. And you want to see those dividends going up over time. And that's what we're seeing here. And here's the dividend history. The dividend will fluctuate like any ETF, but the dividends are very, very consistent. You're going to get about a 6 cent dividend every single month. And this ETF only trades at like, I think, $14 per share. So the dividend's not going to be as much because the share price is lower. But if this ETF grows in the long run, then that dividend is going to go up as well. And yeah, I really do like PEY. Once again, is the ticker. I love this ETF, and I think it's a good long-term investment. So Wisdomtree US Dividend Growth ETF, DGRW. Now this ETF, as you'll see, going back to 2013, has gone from about $25 per share to $45 per share. Now what I will say about this ETF is that it has a lower expense ratio than the other two ETFs, and we're going to get into that in a minute. But this ETF also has more holdings. So let's go to the next slide and I'll show you what I mean. So the yield on this ETF is 2.11%. Now you're getting a lower dividend yield, but the expense ratio is only 28 basis points or $28 on a $10,000 investment. And you'll see also that the sector allocation is almost all large cap stocks. So if you're looking for more of a growth potential, or if you're more of a growth minded investor and you want to take more risk in exchange for more reward, this ETF probably is not the best for you, because I'm not saying you can't get growth from large cap stocks, but at the same time, this is more of like a slow and steady type ETF, investing in companies that are already well established. And so the yield is also not the highest. It's one of those things where I think I probably prefer SPHD and I'm sorry, PEY, SPHD and PEY. I like those ETFs better because they have a higher dividend yield. And honestly, the share price performance has been consistent. But I'm not saying you can't buy this ETF as well, because it's good to diversify. I mean, this is primarily a large cap investment, and then maybe you could buy PEY or SPHD to get exposure into those stocks as well. So it's one, I like this ETF. I'm not saying I hate this ETF, but at the same time, I would probably prefer SPHD and PEY versus this one. So here are the stocks within the portfolio. You'll see technology is the largest sector holding. You have healthcare at 17.52%, communication, and all these different sectors. But technology, that's definitely a sector that, like Amazon, Apple, I believe those are in the portfolio. So, and this is 100% US companies as well, this ETF. Now, going over the dividend growth rate, one thing I do like about this ETF is the dividend growth over the last several years. I mean, dividends have doubled in the last 7 years. So that's very, very good. Since 2013, we've gone from about 50-cent dividend all the way up to $1 per share. So definitely a good ETF. And like I said, I'm not hating on this ETF. That's why I'm recommending it in this list. It's just one of those things where I would personally prefer to invest in the other two ETFs because of the higher dividends, and also because the share price performance has remained about the same. So as you'll see here, the dividend amount, it fluctuates. Going back to 2019, we're at 7 cents per share, and now we're at 7 cents per share again in 2020, 9 cents per share, 10 cents per share. So these dividends seem like they're a bit more volatile than the other two Invesco ETFs that I recommended. But still a good ETF. If you're a dividend growth investor, you can reinvest those dividends and compound your wealth over the long run. And if you're a retirement investor and you're looking for cash flow, I mean, these ETFs can be good as well for monthly income. But anyway, guys, I want to thank you for watching this video. And if you like this video, if you got value out of this video, please hit that subscribe button. Please hit that like button. And I'll see you guys in the next video. Thanks.